Hey, in this video, I'm going to quickly show you how to buy call options in Robinhood for beginners. I'm going to show you how to actually do it, a tutorial, but also the best strategy and ways to think about buying a call option. I'm using Robinhood, and I'm going to show you an example on Charles Schwab as well, but this strategy works anywhere that you can buy call options, like Fidelity, Interactive Brokers, etc. First thing that you want to do is pick a stock. So I'm going to be using Apple right now, but I'm also going to show you some different examples. So using Apple, the first thing I'm going to do is click Trade Apple Options. Now you want to decide if you want to go for a short-term expiration or a long-term expiration. So here I'm going to use a shorter term expiration and go for October 18th. Now if you scroll down further, you can pick an expiration that goes out until 2025 and even out until 2026. I'm going to cover the benefits of going longer term and going for a leap option. So anything that's over 1 year is going to be considered a leap option. I'll go over that in just a second. Using October 18, you can see how the option chain here provides us many different strikes. All of these strikes, regardless of which option that you pick, gives you control or leverage of 100 shares. Buying a call option gives you 100 shares of exposure. Let's go for the 235 call option. Right here you can see that I can purchase this call option. It'll cost me around $715. Now this gives me the right to buy Apple at $235 per share, and this option expires October 18th. So basically, if Apple goes above 235, I'm going to be controlling 100 shares, and I can exercise my right to buy 100 shares at any time. However, you don't actually want to exercise. What you want to do is you want to make a profit on the option itself. The whole goal of buying call options is you can buy them cheap and sell them more expensive. You can see right here that if I click continue, I'm going to have like a confirmation page right here. So I can enter the amount of contracts that I want. Let's say 5 or 10. And right now you will see that there's a bid and ask price. Say that you want to buy 10 contracts of Apple call option. Typically there will be a bid and ask. Well, because the stock market is full of buyers and sellers. A person selling this option wants $7.10. A person buying this option wants to pay $6.90. If you want to get executed on this option, you can either put a market order in your brokerage, or if you're using really any brokerage, Robinhood, then you want to put a limit price. You want to put a limit price that you will get filled. You can also see in my other portfolio, I'm going to show you an example of Apple in the same way. So if I click Apple right now, if you're using another brokerage, it's going to be basically the same exact thing. So if I go to trade, and then I go to open a position, and then I go to option, I can now enter a symbol. So I can enter AAPL, call, and then you'll see I have all the data here, very similar to Robinhood. Every brokerage is very, very similar. So if I go to action, I can buy to open. You always want to buy to open if you want long exposure into a call option. You're betting on it rising, and if you don't have the position, you buy to open. Now, if you already have the position open, then you can also sell it to close. However, I want to buy to open. Again, you can pick the amount of contracts that you want. So 1, 2, 3, and etc. Here you can pick an expiration date. So I'm going to go for the 10/18 expiration again. Now I'm going to pick the expiration. So I'm also going to pick 235. And now you'll see that the bid and the ask is basically the same thing as I just showed you on Robinhood. There would be no way that one brokerage would have better options than another brokerage, because then there would be a potential for arbitrage. Arbitrage basically means that there's two different prices for the same option or the same good in general. Now let's talk a little bit more about strategy. I like buying call options when I'm bullish. I'm buying call options because I want exposure to the upside. You can see here on the profit loss chart right here that essentially if you're going to be buying this call option at 235, then you start making money at 242.10. Well, why is that? Well, it's because you're paying $7.10 in this example, and that is going to be added to the strike price. So 235 is a strike price. You're paying about $7, so your break even is going to be $242. And that means that you're not going to make money unless it goes above 242. But wait, you can actually make money at any time, and you can take a profit on the option before expiration. This right here is actually what happens at expiration. So if the option goes until the last day of expiration, if it's at 242.10, you've broken even. If it's anything above, you've made a profit. But actually, call options are very interesting because you can make money in, say, a day or even an hour or even a minute. That happens when the stock rises. So as you can see right here, the option isn't moving that much. But if Apple stock moves up by $1, then the call option right here would actually move up by about 50 cents. That's because when the stock moves up by $1, you can calculate how much the option will move up by simply adding the delta multiplied by the call options, by multiplying the delta times how much the stock has gone up. So if it has gone up $1, it's going to go up by 50 cents on the option. If it has gone up by $2, it's going to go up by $1 on the option. You can always do that by multiplying delta and the move higher. So say that I think Apple is going to be a $240 stock. Would I buy this call option? Well, it depends. If I think $240 will happen at expiration, I would actually not buy this option because the break-even price is $242 per share. That means that I would actually lose $2 if I were to buy this call option, and it would to go to $240 per share at expiration. Mind you, Apple is currently at $232 as I'm making this video. Now, if it actually went to $240 and that happened in the next 1 or 2 days, then I would actually make a lot of money. It would go to $240. The current price is $232. That means I would have a rise of $8, and the delta right here would basically mean that the option would go up in value by $4. Now, why the difference? Why is it that at expiration, things are so different than just a couple of days? Well, that's because of theta, okay? Every single day the option is expiring. So in a short amount of time, if the stock goes up, the option will make a lot of money because theta hasn't really kicked in. But as the option approaches expiration, then theta is really kicking in and it's going to take a big chunk out of your option. So in this sense, options can be very difficult and this is hard to calculate. But the whole point of buying a call option is that you make money as the stock rises and you hope that the stock rises very quickly. Let me show you a trick using Yahoo Finance. I'm going to show you some technical analysis. If you're buying call options, you want to pick a stock that has really good momentum. Right now, if I go to Apple and I go to the 3-month chart, Apple actually has very amazing momentum. It has gone from $207 per share all the way to $232 per share in a very short amount of time. In fact, if you look right here, this stock was actually $207 in early August, and now in basically late August, that's at $232. So that has been a really big move. And in fact, that's part of the reason why I've actually been able to catch Apple very early. And I currently have a lot of my portfolio in Apple stock and I'm up $358,000. Now, I'm not personally buying call options because this channel is mainly about selling options. However, if you were to buy some call options in Apple, you would be absolutely printing money. The trick is you want to find a stock that has low RSI. So for Apple, the RSI was actually around 35-ish back when Apple really dipped here in early August. This was a really bad day where a lot of people were panicking. This was also a fantastic day for someone that is willing to take some risk to buy a call option. See, call option buying is pretty risky. However, at the same time, the rewards that you can reap from buying a call option are absolutely huge. You can double, triple, and much more extra money by buying call options. Right here, from 207 to 232, this was a really big move on Apple. What I typically like to look for is not just low RSI, I also like to see really good momentum. So I personally was not able to catch Apple at this low. I'd be lying if I did. However, I did buy Apple at 216 and I actually got a really good pop still on the upward action because once I saw that this momentum had a really big recovery, I jumped in on the action. That's a really good thing that you want to look for in a stock's chart because as a stock moves up and you buy a call option, your call option is going to go up in value. The option rules that I go for when I'm buying call options is I limit my call option exposure to just 2% per position. So say that you have $50,000. That means 2% of $50,000 would be $1,000. You wouldn't want to put more than $1,000 in a single position because when you're buying a call option, and if it doesn't go in your favor, you can lose part of the option's income. You can lose part of what you paid for the option or even the entire amount if the option expires and it's out of the money. So it becomes really interesting on how to actually manage a call option. When you buy call options, you have to be ready for significant risk. However, you don't have to lose the entire amount. If the option isn't going in your favor and half of the time has gone by and the option is not up in value, and let's say that is down about 25%. Here's what I mean. If the option is down 25% of what you paid, so for example, if I go back and go for, let's actually go for a longer term option. Let's go for January 17, 2025. So if I were to buy this option right here for $14 or $1,400, this is what I would do. Let's say that Apple goes sideways and it's not going in my favor, and this option is now worth $11.50. I'm actually taking $3.50 off of this option premium because 1/2 of the option premium is 7 and half of 7 is 3.5. So I know that half of a half is 25%. So I just did the mental math and I know internally that around $11.50, that would be a 25% loss. Now for me, that would be a really good time to cut this option position because if you've lost 25% on the option, it could be a very good time to cut your losses and manage your risk. Now for me, in my experience from working at Goldman Sachs, I've seen hands-on that some of the best times to buy a call option is when there is an earnings event or there's another event that might impact the stock significantly. So let's take earnings, for example. When a company reports earnings, that is a big shock in the market because there's a lot of investors that are expecting either a big rise or a big fall in their earnings. And let's say that the management is very bullish and they come out with really good numbers. Well, in that scenario, the earnings are going to be positive, and that's going to be a positive shock to the market, which means that the stock will react positively in most scenarios. That's exactly what I'm looking for when I'm buying a call option. I'm looking for the call option to be worth more than what I purchased it for. And it's going to be worth more if the stock's value rises. So the best strategy is picking a rising stock, and preferably a stock that goes up a lot in a short amount of time. That can happen very often during an earnings event. So if you're bullish on an earnings event, and we can take something like Nvidia, for example. Nvidia has recently had earnings. Many people have bought call options because they wanted to bet on the stock rising. Nvidia reported some good numbers. However, the stock did not rise. The stock is actually down 4%. Now, luckily, I'm making money on the stock and I did not buy call options. I actually have an iron condor here, and I also have some put credit spreads. I made $1,000 just today, and this is a position that I've recently opened up in my Discord community. So I made over $1,000 in a short amount of time here, and you can see here that this is more of an option selling strategy. However, buying call options can work, but you have to be right on direction. So had you done buy a call option on Nvidia, you would have lost pretty much all of the money in even a single day, because when a stock has earnings, the earnings actually make the stock more volatile. So option prices actually implement more volatility. Because there's earnings, everyone knows there's earnings, the option premium will be very high. So it's actually a double-edged sword. It's very profitable to buy a call option 3 days before earnings on a stock, especially a positive blue chip stock that has good momentum and key fundamental analysis that I look for. However, if it reports earnings, they don't go well, then you end up losing quite a lot of money. So you want to be very careful with how you buy call options. It's hard to manage this strategy, but you can also reap a lot of rewards. And don't forget that you can take profit at any time. Let's say that you opened up a call option, only a couple days has gone by. If the option is up 10 to 20%, honestly, in most cases, I will just take profit. If you want a full tutorial on buying options and selling options, creating income, I've actually created a 4-hour course that you can check out on the screen right now.